The Reserve Bank of New Zealand cut the cash rate by 25 basis points to 3.25% in May, as was fully priced, but it was the policy debate that really caught markets off guard at this meeting. See, the decision wasn't between a 25 or 50 basis point cut as seen earlier this year. It came down whether to cut or keep the cash rate steady. One member voted to do just that, highlighting concerns about rising policy uncertainty and sticky inflationary pressures. Now that matters because the RBNZ has a single mandate, and that's to keep inflation anchored at the 2% midpoint of its 1 to 3% target. Ominously, it noted inflation expectations among households and firms had risen, even with core inflation still easing. And that's what made what happened next all the more surprising. Despite the more cautious tone and split vote, the RBNZ lowered its rate track forecast. It now sees the cash rate bottoming at 2.85% in early 2026. That's 25 basis points lower than February. And it suggests a bias to put policy into stimulatory territory, even as some on the committee were worrying about cutting rates at this meeting. Traders now see another cut in July as a very close call, although a 25 basis point reduction in August is deemed nearly a lock. Pricing still allows for a move to 2.75% should inflationary pressures undershoot, but momentum is clearly shifting towards 3% being the floor for the cash rate this cycle. We think that risk remains skewed to a move below 3%, given excessive levels of labour market slack which should limit wage growth and domestically driven price pressures. There's also very little support coming from fiscal policymakers, suggesting it may be some time before the economy is operating above its potential level.